Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning, everyone. Welcome to first week of April. Normally, we'd be talking about tax day coming up on April 15th, but that has been delayed. So July 15th, contributions. And as many of you also know, and this is something that's important to discuss, is that as a result of the Secure Act, that are not required to take, actually this is as a result of the CARES Act, we've got the Secure Act prior to the CARES Act, as a result of the CARES Act, they're not required to take required minimum distributions this year. So going to get started this morning. First off, I want to thank everybody for the tremendous work that everyone at Lanton has been doing, and the teamwork and the camaraderie in this very stressful environment, very stressful period in the markets, and unable to, in many cases, be in the office. And the demonstration of care for the clients and the work ethic has been remarkable, and want to take again a moment to say how appreciative I am and the whole team at Lanton is for all the hard work that everyone's doing, and I'm confident that it will just lead to greater success going forward. Put it in perspective, what each of us has been managing through. We are in an unprecedented time because we're not only in an economic crisis, but we are in a health crisis that only exacerbates the stress. Markets have experienced tremendous and wide-ranging volatility. Equity markets dropped from their peak into a bear market in 16 days. That is the most violent correction on record. The VIX surged to 82.7, an all-time high, surpassing implied volatility seen during the financial crisis. We have seen this volatility in every market, not just stocks, but bonds, commodities. Oil prices experienced their single largest day drop since 1991. Treasury markets, usually one of the most liquid, also experienced their worst volatility since 2009. We've seen extreme volatility in high-yield bonds. We've seen extreme volatility in normally quiet, boring municipal market. Now, as we know, this stressful time is still going on, still ongoing. So we need to pick up, not just pat ourselves on the back, but maintain that resolve and continue to produce the quality interactions that we're doing with our clients. This morning, was reading an article. I think it was in Wealth Management this morning, and they talked about some of the best books to read. And this was coming from some market experts on what are the best books to read. And I thought this was something that was good to think about here. Some good reading as we are all working hard to provide advice to clients and find words of wisdom. Some thoughts if you're thinking about how you can expand your capacity perhaps to articulate some of the themes that are taking place. Book written in 1841 by Mackay in Great Britain, Extraordinary Popular Delusions and the Madness of Crowds. Another book to think about is The Wisdom of Crowds and Why the Many Are Smarter Than the Few by Sorauki. This book talks about why some of us often think that we have greater insight into a situation, whether it's a stock or a fallen angel bond. And we know that this is a great buying opportunity, yet it's off 40, 50, 60, 70%. This book talks about why usually if you are that standout and thinking that you know more than the crowd, in most instances you're probably mistaken. In this environment, Seth Klarman in 1991 wrote Margin of Safety, Risk-Averse Value Strategies, and then something talking about not just investments, but decisions, and decisions about things like health, wealth, and happiness, something that's certainly pertinent today. Book written about 15 years ago, Nudge, by Sunstein, and then two classics that are always always helpful to reorient ourselves. Random Walk Down Wall Street and The Intelligent Investor by Benjamin Graham. Over the weekend, Kevin Leahy had sent me a synopsis of the economic outlook put together by a company called FS Investments, and I thought it was really well done, and thought I'd share some of the insights with you on what the outlook is for the second quarter of 2020, which has just begun. And I thought that their analysis was concise and spot on. Appreciate Kevin sharing it with me. Some of the thoughts here in this opinion piece by FS. Number one, a recession has begun, and its scope and length will be shaped by the pandemic. Number two, policymakers have acted quickly and aggressively with the likelihood of more to come. And the third, perhaps something we're seeing this morning, financial markets will be whipsawed between recurring waves of uncertainty and support from policy. Taking a look at different specific sectors of the market, they talked about the energy sector, and what's amazing right now, if you think about it, is we are somewhat rooting for higher oil prices. Just a decade or certainly 2 decades ago, before the shale revolution in the United States, lower energy prices would be viewed as a strong positive for the U.S. economy, as lower gasoline meant a stronger consumer. However, as the U.S. has grown to be the largest oil producer in the world, lower crude prices have a negative impact on business investment. During the last downturn in energy prices in 2014, employment in the oil and gas sector fell by 36%, and it has never recovered to the levels seen prior to that downturn in 2014. Nevertheless, there are still 470,000 workers directly in the energy space in the United States, and they support hundreds of thousands more. So prolonged downturn certainly has a meaningful effect on the U.S. economy, especially in those states that have heavy energy and oil and gas exposure. Also, when you take a look at the current downturn and the volatility that we have seen in this downturn, diversification has somewhat broken down in this latest downturn. Perhaps we'll see that start to see things differentiate themselves. Actually, article in Barrons talking about that. But nevertheless, give you some idea of asset correlations. Typically, the Barclays Aggregate Index, which is high-grade investment, short-term investment-grade corporate bonds, are barely, if at all, correlated with stocks. From 1995 to 2020, on average, they're actually negatively correlated by about 0.05%, indicating there's almost no correlation between those bonds in the Barclays Ag and stocks. Yet in the 2020 COVID crisis, the correlation between the Barclays Ag and U.S. equities is 0.57 or 57%. Usually there's no correlation. Even during the financial crisis, that correlation was about 0.38%, so seeing significantly more correlation. The correlation between the S&P 500 and public REITs is 98%. Going back to 2007, when the real estate was what could be argued dragged us down. That correlation was 83%. So seeing greater correlation today than even in the financial crisis for real estate. Commodities is 85%. Going back to 2007, 2009, that was 52%. One interesting note is international equities, which are typically about 84% correlated to U.S. equities. In the financial crisis, it was up to 91% correlation. In this crisis, it's 44%. So international stocks are not as correlated to U.S. stocks. And if you have international stocks in your portfolio, you're seeing the benefits of that diversification. Typically, if we are going into recession, which seems extraordinarily likely to me, equities usually fall at the start of the recession, and they typically bottom somewhere between 3 to 6 months before the end of the recession. And this recession that we're going in is particularly difficult to measure when that recovery may happen, because what we have here, if you want to look at a silver lining, is we have unprecedented support from the Fed and from the government in terms of stimulus. The stimulus has come very quickly, so it is unprecedented, the speed of assistance that has been provided. And since we don't know how quickly we will come out of the pandemic, makes it very hard to accurately measure. Makes our job as advisors that much more difficult on how quickly we should be redeploying into equities. When you take a look at different asset classes and you look at returns from February 20th to March 20th, give you some scope here, and I know that's a relatively distant past. It's about 2 weeks ago, but equity markets were roughly where they are today. The S&P down about 30% from its highs. Leverage loans and high yield are down about 20%. Investment-grade corporates, which have recovered somewhat, are down about 10%. Munis are down about 4% from their highs. And the Barclays Ag is down about 3%. Credit spreads in high yield or junk bonds are about 900 basis points over treasuries on the very high end of historical levels. What can we anticipate? This comes from this FS Investments. What can we anticipate as a consequence of the COVID-19 pandemic? And they came up with some thoughts that I thought made a lot of sense. Number one is we may have a national biomedical defense initiative. This could be an initiative of $1 trillion or more over the next several years, where we invest in vaccines and in biotechnology to hopefully prevent another crisis like we are experiencing today. The Great Depression gave us the SEC. The OPEC oil embargo gave us the Strategic Petroleum Reserve. 9/11 gave us the TSA and lots of building security and lots of barricades. So it wouldn't be surprising to see the country embark on a major initiative to return the pharmaceutical production back on, to stockpile perhaps vital medicine, masks, and other PPE. Also, what we're seeing modern monetary theory become mainstream. What is modern monetary theory? It's basically a theory that says the amount of the deficit is not that important. As long as you're the reserve currency, there's lots of leeway to print money. No one knows exactly how far that band goes. But both Republicans and Democrats seem to be very on board with the increase of the deficit and with greater monetary policy. And finally, we are seeing an embrace of telecommunication. This includes telecommuting, telemedicine, teleconferences, teleschool, and some of the effects of this pandemic may be that tele has a lot more to do with our lives going forward than it did in the past. Telemedicine especially may be a more common way to interact with doctors. And finally, just to give us all some perspective on the U.S. economy and which sectors are most vulnerable and what percentage of the economy is shut down. When you take a look at the U.S. economy, it's about 25% goods. It's about 45% services. That's about what the U.S. consumer makes up, about 70%. And the other 30% is government spending and business spending. And government spending is expected to increase. Government spending is about 17%, could potentially tick up to 20%. So you've got 20% of GDP that's probably going to continue to go on relatively uninterrupted. At the same time, looking at what is going to be relatively uninterrupted is healthcare, which represents about 12% outside of the government, which provides some healthcare, which is about 12% of our economy. So you take that 20 and you add another 12, and you're up to about 32% of the economy is going to continue moving forward. Then you take housing and utilities. While there may be some hiccups there, it's very likely that people will eventually continue to pay the rent, pay the mortgage, pay the utility bills, and that makes up another 12%, so you're up to about 45% of the U.S. economy. Then you take into account those non-durable goods, things like food, things like household items like detergent, cleaners, things like that, and you probably can add on another 10 to 12%, and you're over 50% of the economy that's going to continue relatively uninterrupted. And then you throw in there business investment, things like intellectual property, which includes lots of the equipment that would be incorporated into working from home, as well as protecting your businesses and that probably will continue as well. So you can fairly say, based on, if you logically think about what makes up the U.S. economy, that somewhere between 50 and 60% of the U.S. economy will continue, even if the rest of it grinds to a halt of zero. Now, it's unlikely the rest of it will be at zero, and the difference for that other let's call it 40% of the economy is going to be what dictates what our future looks like going forward, how fast that gets turned on. But I think you could safely say that 50 to 60% of the U.S. economy is continuing to go forward. I'm going to talk for about 5 to 7 more minutes, then turn things over to Brad. Got a lot to talk about, so I could talk for a long time this morning. But first I'm going to talk about where we were last week, then we'll talk about where we are this week. Last week, we saw markets down anywhere between 1.5% on the NASDAQ and 2.5% on the Dow. Put things into perspective, the Dow's down about 25% year-to-date. The S&P's down about 23%. Treasuries year-to-date, none of this is from the high water mark. Everyone likes to look at things from the high water mark. This is year-to-date numbers. Treasuries are up about 11%. That's the 10-year Treasury, and munis are down about 2.5% year-to-date. Looking at futures this morning, Dow futures up 750. S&P futures are up about 90 points. Oil's down about $1. Delay in the OPEC and Russian meeting till next week, leading to a little bit of disappointment. And Treasuries off this morning, but still the 10-year yield is still at about 65 basis points. So again, Treasury yields still remain extremely low. What's going on this morning? Signs that the COVID pandemic could be improving. For instance, New York Governor Cuomo said the daily corona deaths in New York have dropped for the first time. New model suggesting that social distancing is working, and that U.S. deaths may be less than initially forecast. Originally, deaths were forecast at 100 to 240. Some new estimates this morning suggesting deaths could range from between 63,000 and 125,000. Obviously, every death is one too many. Overseas, Spain and Italy are reporting fewer deaths than before. Governor Cuomo did caution that it's too early to draw conclusions from one day's worth of data, and Surgeon General Adams warned this week will be the hardest for the U.S. Still, the data has helped sentiment this morning. Mentioned crude and mentioned the delayed meeting. CNBC is reporting that the meeting, which will discuss potential production cuts, is likely to take place on Thursday. Last week, crude prices did bounce 30% on production cut hopes. Taking a look at the dollar, it's relatively flat this morning. Dollar index is at year highs at 100.7. Jamie Dimon out this morning with his annual letter, saying that J.P. Morgan would consider suspending its dividend only during extreme adverse conditions. He did caution on the economy on CNBC this morning. Delta Airlines and Southwest Airlines in the news after Berkshire Hathaway said that they sold stakes in both companies. Berkshire sold about a fifth of its stake in Delta. Delta did say that second quarter revenue is expected to be down about 90%. Equity indices in the Asia-Pacific region began on a mostly higher note. China was closed, but the Hang Seng was up 2.2. The Nikkei was up 4.2. Korea was up 4. Australia was up 4% as well overnight. Also, Dr. Scott Gottlieb on CNBC says modeling for corona deaths is improving. Dr. Anthony Fauci said this will be a bad week, but we should hope that within a week, maybe a little bit more, we'll start to see a flattening of the curve and for it to come down. Just seeing this cross the wires that Saudi Arabia and Russia say they are very, very close to a deal on oil. So, a couple of other stories this morning. U.S. banks being pressured to cut their dividends. Barrons actually ran an article on why they think U.S. banks won't have to cut dividends, but that is a topic that is getting lots of attention. We have the stress tests being done this Monday on the U.S. banks, and banks will be potentially making their case on why they can maintain their dividends. Moving quickly to a couple of stories in Barrons. Barrons wrote an article on the Dow dropped 580 points this week, why that's good news, suggesting that despite the volatility last week, the volatility was a lot lower. VIX fallen below 50, which is still a high number, but down from 70 to 80. And what Barrons pointed out is that they think that we're moving into the next stage of the coronavirus where markets are picking winners and losers. It's no longer invest in SPY or the S&P 500. It's becoming more of a market where companies that can thrive in a corona-induced world can perform better, and some of the sectors like the travel industry are struggling. Barrons also wrote an article on why the bottom is not yet here for stocks. They say a look at the last 800 years of economic data shows why. They delved back into the Bank of England's records for the 13th century, and if you're wondering about what happened during the Black Death, at the peak of the Black Death in 1349, England's economy shrank by about 23.5% based on estimates. Also, if you look historically at bear markets, most bear markets retrench or retest the entire run-up. If that were to happen, we'd be looking at a level on the S&P 500 somewhere between 1,100 and 1,500, depending on what point you pick as the beginning of the bull market. Article is quick to point out, though, that although it's a dangerous thing to say, this time might be different because of the very unprecedented fiscal and monetary stimulus response. Barrons also talked about companies that they think will be able to maintain their dividends even in the most austere environments, and they cited the dividend aristocrats, of which there are 64, and of that 64, they highlighted 8 that they think could be super resilient. Those are Abbott Labs, Chevron Texaco, which is yielding 7.2%, and in the energy space, as you know, but nevertheless, they feel that they can withstand lots of further volatility in energy. Hormel Foods, HRL, J&J, Johnson & Johnson, Kimberly-Clark, KMB, Medtronic, MDT, Procter & Gamble, and T. Rowe Price already making the list. Also mentioned banking sector. Barrons wrote an article, another crisis has come to Wall Street. This time it's ready. Talking about the fact that credit quality is much higher than during the financial crisis. Banks have been very careful of who they make loans to. Consumers are in far better shape than they were in 2007. We're entering this crisis with the lowest household debt service ratio since 1981. Also, we have a positive savings rate in 2007. We had a negative savings rate. New York banks have other things going for them. We have interest rates are at rock bottom levels, which is fueling a mortgage refinancing boom. Also, we have $2 trillion stimulus coming into the economy, which will hopefully help those most in need. Also, when you look at capitalization, U.S. banks have about $7 in assets for every $100 in deposits. That level is significantly higher than it was in 2007, and New York banks in 2007 had $5 in deposits, $5 in capital for every $100 in deposits. Now they have $10, so double. And when you look at valuations, J.P. Morgan is trading at 1.38 times tangible book. Morgan Stanley's at 0.83. Goldman Sachs is at 0.68, and Citigroup is at 0.53 times book value. Finally, talking about the bond market, going to turn it over to Brad to talk about this in further detail. But Barrons did run a very good article for those of you who are invested in bond funds, and they sort of go through the bond funds and highlight the funds that have done best and worst in this environment. And it's interesting if you take a look at some of the funds that had been poorer performers. They had been more conservative. Those are the funds that are performing better. The more aggressive funds that had been the better performers are the ones that are suffering the most from the volatility. But that doesn't mean that the funds that are performing worse necessarily in this environment are worse funds. You take the good with the bad, or you take the bad with the good, and you have to make a decision on whether or not you want to reach for that yield or if you want to be more conservative. Give you an idea on a couple of funds. The American Funds Bond Fund of America is up 3.9% year to date. Over the last 10 years, it's returned 4.2% per year. Compare that to the PIMCO Income Fund, which over the last 10 years has returned 6.9. That's versus the 4.2 for the American Fund. But the American Fund is up 3.9% year to date. The PIMCO Fund is down 7.8. So you just have to make a determination on what level of volatility you can withstand and what sort of returns you are striving for. Finally, in the Bloomberg, there's an article there on Illinois facing record penalties for their bonds. Illinois debt trading at the widest levels to municipals since their own little crisis began. And just want to reiterate, this sort of highlights the danger to being close to the precipice. If you're close to the precipice when a crisis hits, these stress levels are going to become a lot more amplified. So we're seeing that currently in Illinois, and that same lesson can be applied across the bond spectrum into high yield and other sectors. That's everything I've got. Turn it over to Brad. A lot to talk about. Sorry, I went a little over. Good morning, Brad.
Morning, Keith. Good morning, everyone. Hope everyone had a good weekend, restful. It's nice to come into an up day after a crazy week. Just a couple things. The municipal bond market has been trading with equity-type volatility. The equivalent of 1,000-point moves in the stock market pales into comparison as to what's been going on in the municipal market. There have been liquidity issues, and now there are, as Keith mentioned, some credit issues. So that's something that we're going to obviously keep an eye on. There are certain people who are going to need to sell because they can't play around with this risk. You need to take this on a client-by-client basis. There are other clients that may want some risk. And if there's a good yielding situation that you may think will work out, that's something to consider dabbling in. Tomorrow, that could change on a dime. Some people want to sell some MTA bonds because that has been the headline of headlines. I have some sources who feel that MTA will be okay, but it's very easy for people who are institutional of nature to take those risks, and certain people should not take those risks. So again, and if I knew the answer, if I thought MTA was guaranteed to pay, I'd put every penny I had into it. But you just can't make that sort of call. You can't make that with a bond. You can't make that with a stock. And I think that it's important to be diversified and properly allocated over a spectrum of bonds as well as everything else that you're doing. So anyway, I hope everybody has a good week. And I'm still praying that we get some more positive news as we got from Governor Cuomo yesterday morning, and let's hope that we get a couple more good headlines. Everyone have a nice day and a nice week.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.